Traditional bank lending for property development became constrained after the financial crisis of 2008. Since then, an alternative funding market is established, with developers now able to seek finance for their projects from a range of specialist lenders with in-house development expertise. Such lenders now offer investors the opportunity to deploy capital into loans secured against property development projects, typically paying a higher rate of interest than yields on mainstream investments. Once a suitable loan is in place, bonds are issued to the investors, providing security over their capital and paying a fixed rate of interest. Loans are secured with a legal charge against a development project, often with further security provided against a developer's other assets and/or through a personal guarantee. Interest is usually rolled up and paid along with the repayment of capital at the end of the loan term. Property Partner will work with expert lending partners to bring a variety of property-backed debt investment opportunities to clients on our platform.
In a typical property development finance model, the majority of the capital is provided by a senior lender, often a bank. This loan will extend to a loan-to-value, LTV, of between 50 and 65% of the expected sale proceeds of the completed project, known as the gross development value, or GDV. The senior loan will receive a moderate rate of interest in respect of a relatively low level of risk that the lender has taken, with the benefit of a first legal charge security over the project. In many cases, developers require additional funds beyond that level which the senior lender is prepared to lend, creating an opportunity for a secondary lender to offer a much smaller mezzanine loan on top. The mezzanine loan will extend to a higher LTV of the GDV and be secured with a second charge security over the project, along with other security and personal guarantees offered by the borrower. The mezzanine lender will typically receive a much higher rate of interest than the senior lender in return for a significantly higher risk profile of their loan. Developers arrange their finance to coincide with the expected completion date of their project and the subsequent planned schedule of property sales. The senior lender is repaid from the proceeds of the sales, with the mezzanine lender receiving their capital and interest thereafter. The developer will only recruit their own equity invested into the project and begin to make a profit once sufficient proceeds have been raised from the sale of the properties to repay both lenders and their interest in full.
We're very pleased to bring a new property-backed investment asset class to our clients. And what sets us apart is that not only do we diligence all aspects of the loan, we bring our years of property experience to the most important part of the loan, the property itself. At the end of the day, it is the proposed property that will ensure the success of the lending agreement. Working at the Global Restructuring Group at RBS, both Jim Story, our acquisitions director, and I dealt with developments that had gone wrong, whether due to market conditions or just ill-conceived schemes. So it's fair to say that we have first-hand experience of what to avoid and the common pitfalls. We inspect the properties ourselves, review the due diligence undertaken by our lending partner and their valuers, as well as carry out our own assessment of values, the strength of the target market, and alternative exit strategies. I would stress that while development finance is very different to considering a property for investment, although looking at it through our property investment lens enables us to consider all potential exit strategies and evaluate the downside protection which a scheme may offer, should the units fail to sell at the predicted rate. This is such a natural addition to our investment portfolio, and our inbuilt property expertise, particularly on the loan recovery side, is where we can add real value to this type of loan product.